Good morning, everyone, and welcome to today's webinar hosted by PYA, reflecting on the impact for hospitals adopting the revenue recognition standard and reporting of bad debt. Before we get started with the webinar, I'd like to go over a few housekeeping items. As this event is for CPE credit, there are some additional steps that we will take in order to comply with NASPA requests. In accordance with NASPA, attendees will be provided 3 polling questions throughout today's webinar. Responses are documented electronically. Attendees must respond to these polling questions within the allotted time in order to receive CPE credit for this course. A post-event survey will also be provided for attendees to submit regarding their webinar experience. The polling questions and the post-event survey must be submitted for proof of participation today. You will have the opportunity to submit questions to today's presenter by typing a message into the question pane of the control panel. We'll collect these and address them during the Q&A session at the end of today's event, if we have time. If not, our presenter will reach out to you directly. Now I'd like to welcome Diane Bennett, with us today from FHA, to kick things off. Welcome, Diane.
Thank you, and good morning, everyone. My name is Diane Bennett, and I'm the Director of Education here at FHA. We are delighted to have the opportunity to partner with PYA in an effort to support our member hospitals. PYA is an inaugural financial underwriter of the FHA Research and Education Foundation and a leading professional services firm providing expertise in healthcare, tax, management consulting, and audit and assurance. With that, I would like to introduce Matt Stuart, Audit Principal at PYA, moderating our discussion today between Mike Shamblin, Audit Managing Principal, and Holly Bizic, Consulting Senior at PYA.
Thank you, Diane, and good morning, everybody. And we appreciate you taking some time this morning to join us on this webinar. Our webinar format this morning is going to be in the form of a panel discussion, and in particular, it's going to focus on what are some of the frequently asked questions that we're hearing from our clients in regards to the new revenue recognition standard and how they're affecting healthcare entities. So our first question will be for Mike Shamblin, and the question, Mike, is why did the Financial Accounting Standards Board, also known as the FASB, change the reporting of revenue for hospitals?
Yeah, thanks, Matt. And I'd also like to welcome everybody to the webinar this morning. So, to answer that question, Matt, I think it's important to note first that really the Financial Accounting Standards Board, or FASB, did not set out to change the reporting of revenue specifically for hospitals or even the healthcare industry. This was really part of a much larger project. It was really due to the fact that when you looked at generally accepted accounting principles, the revenue recognition guidance that was out there previously was really a lot by industry and kind of spread throughout all of GAAP. And so hopefully everybody in the webinar today is aware that, several years ago, GAAP was codified. And so if you were going to look for revenue recognition guidance in GAAP prior to this revenue recognition standard, you may have had to look several different places within the codification to find the specific guidance for your specific industry you were interested in. So healthcare specifically, you would have had to look for one specific place. So really this was an effort FASB undertook where the main purpose was to come up with a single standard that could be applied across all industries, of course, including the healthcare industry. So there really was no single industry in mind. However, the American Institute of Certified Public Accountants, so the AICPA, a different organization from FASB, but they certainly have the AICPA has a vested interest in everything that the FASB does, because the AICPA is the body that sets the auditing standards and the test standards. So they have a keen interest in the new accounting standards that FASB is setting. So the AICPA did create industry groups to evaluate the impact of this new FASB standard on revenue recognition. And there was a healthcare industry group that was created by the AICPA to focus on the impact of the revenue recognition standard for the healthcare industry. And so that industry group helped the AICPA publish an interpretive guide. Essentially, it's not authoritative. It's not an authoritative part of GAAP when you think about the hierarchy of generally accepted accounting principles, but it is interpretive guidance that helps the healthcare industry, helps hospitals to implement the new revenue recognition standard. So hopefully that helps answer that question. It really wasn't anything FASB set out to do specific for hospitals or the healthcare industry, but really it was just more of an overall project that the healthcare industry got involved in, of course. So.
Great. Thank you, Mike. Our next question is, some of you may be thinking, all right, well, that's great and all, but where do my bad debts go? And what we mean by that is, if you've seen some financial statements that have been issued since the new revenue recognition standard has gone into effect, you may have noticed that the lines that used to be there on the financial statements for bad debts are no longer there. So really this question centers around, do bad debts still exist, or are they hidden somewhere in the financial statements? Really, where do they go? So Mike, this question is also for you. Yeah, so I think this would probably be the single biggest issue really that came out of the new revenue recognition standard. Matt, you've already hit on it. As the healthcare industry started really assessing what is the real impact of the standard on my financial statements, and particularly my income statement, what they quickly realized is, okay, this may not impact my bottom line, but my bad debts are going away, and help me understand how all that works and where are they going. And so I think to answer this question, it's probably going to be helpful to provide some context of just the history around bad debt expense reporting. And so I'm going to take everybody back in time a ways, and we're going to go all the way back to 1972. And on the screen, you're going to see the cover of what was called the Hospital Audit Guide, published by the AICPA back in 1972. And while I certainly don't want to read to anybody today, if you'll bear with me, I'm going to take one quick second to read an excerpt from that Hospital Audit Guide from 1972. So this says, charity allowances, other arrangements for providing service at less than established rates, and the provision for uncollectible accounts should be reported either separately from gross revenues under deductions from gross revenues or by some other disclosure. Allowances of this type should also be accounted for on an accrual basis. So again, that was interpretive guidance back in 1972. And so, what I pick up on there, and I'm sure everybody else does, is we're talking about reporting essentially this bad debt provision or bad debt expense as a revenue deduction account. So if we look at the next slide together, this is what was Exhibit B from that same AICPA guide back in 1972. And you see the line item that I've got highlighted there in yellow shows where that would show up in this illustrative example for this sample hospital. So you see the patient service revenue line above that, or what was the current year then, the $8.5 million. And what's important to note, I think, here is that patient service revenue line item would already have been net of contractual adjustments, for example. So that was already gross charges less contractual adjustments. But then you had this line item, this other revenue deduction essentially for the bad debt expense or provision for bad debt, all those interchangeable terms that we use for that, showing where that would show up in a hospital's financial statements at that time. So we had that guidance, that interpretive guidance back in 1972 of how to present that. So then we're going to fast forward all the way from 1972 to 1990. And now what you're seeing on this slide is a cover from the AICPA's Audit and Accounting Guide for Audits of Providers of Healthcare Services. So one interesting note is that we changed from the Hospital Audit Guide just to Audits of Providers of Healthcare Services, certainly a broader audience they were trying to reach with this guide. So in 1990, we now have this new interpretive guidance, and you see on this next slide, again, just a quick excerpt from that guide that highlighted in yellow here says, bad debts are to be reported as expenses in accordance with generally accepted accounting principles. So no longer a revenue deduction, but now we're talking about reporting bad debt as an expense. So if we look at the illustrative example from that guide in 1990, we see at the top where we see our net patient service revenue, again, that would have already have been net of contractual adjustments.
But we no longer see the revenue deduction line item in the revenue section. Now we have to go down to operating expenses, and it's the very last line item under all of our operating expenses, provision for bad debts. So we see this reclassification that was prescribed in 1990 to change what really had been the interpretive guidance for the industry from 1972 until this point in 1990. So we had that change in 1990. Now we're going to fast forward from 1990 to 2011. And what you see on your screen here is actually from the FASB, not from the AICPA at this point. This is a Financial Accounting Standards Update. It was number 2011-07. And you see it was for specifically healthcare entities. So you're going back to my comment a few minutes ago. Previously in GAAP, we had revenue recognition type guidance by industry spread throughout the codification. Now, this is an example of that. So now we've got this new guidance out here in 2011. And just to read this quickly, the section highlighted in yellow, the amendments in this update require certain healthcare entities to change the presentation of their statement of operations by reclassifying the provision for bad debts associated with patient service revenue from an operating expense to a deduction from patient service revenue, net of contractual allowances and discounts. So does that sound familiar? That's so 1972, right? So basically we're coming full circle now, and we've gone back to essentially what the AICPA had prescribed back in their 1972 hospital audit guide. So if we take a look at the simple little table they provided in 2011-07, you see again the starting point of patient service revenue that would have already been net of those contractual adjustments. And then you see as a revenue deduction the provision for bad debts to come down to a net patient service revenue less provision for bad debts. So really, we're essentially back to where we were in 1972 under that guidance as we sat in 2011 with this new update. Now we're going to fast forward to a little more recently, 2019, and this is the AICPA's Audit and Accounting Guide for Healthcare Entities that had been updated for this new revenue recognition standard that we're talking about today. So we're now back to present time. So to really think about what the change is with this new revenue recognition standard, I'd like to give everybody a fact pattern and then kind of see how this is going to play out under the previous guidance and then under the new guidance. So let's assume, just as a set of facts, that we've got gross charges of $15,000. We've got contractual adjustments. So we've agreed with third-party payers that contractually we're going to accept less than our gross charges. And so you'll see parenthetically, we have the term explicit price concession. So that's a new term that we have given to us through the new revenue recognition guidance. So we've got $5,000 of contractual adjustments or explicit price concessions. We have an adjusted net revenue, just simply the $15,000 less the $5,000 of $10,000. We're going to assume we have a third-party payment of $8,000, and so we're going to assume a patient portion of $2,000 that the patient's responsible for, and we'll assume that our history tells us that from a collective evaluation of, let's say, self-pay patients, that we're going to collect about $500 of that $2,000 patient portion. So we're going to expect to collect about 25%. That's what our history tells us. So then we're saying that we've got a $1,500 implicit price concession under, again, a new terminology that the revenue recognition standard gives us, this implicit price concession, the difference between the $2,000 and the $500. So that's our fact pattern. So now let's take a look at the next slide. If we look at a set of financial statements under the previous guidance in GAAP, and we look at that fact pattern, we would have had $10,000 of net patient service revenue because we would have taken our gross charges. We would have already netted those for the contractual adjustments to get to a starting point in our GAAP-based financial statements of $10,000. We would have shown estimated provision for bad debts as a revenue deduction, again, going back to that 2011 guidance of $1,500, and that would have gotten us to net patient service revenue less estimated provision for bad debts of $8,500. Under the new standard, we would essentially just have a net patient service revenue line of $8,500, which would represent the $8,000 that we expect to collect from the third-party payer, as well as the $500 that we expect to collect from our self-pay patient. So you see it's a different starting point because we're almost, one way you can look at it is almost treating that estimated provision for bad debts kind of like the contractual adjustments have been treated, and netting that out before we get to our starting point of what we show as beginning net revenue for our GAAP-basis income statement. So hopefully that example and quick history lesson helps to answer that question of why bad debt has gone away on this new format.
Thank you, Mike. Now I think with that, it's time for our first polling question.
Thank you. Our first polling question is, do you like the fact that bad debt expense is no longer reported as a separate line item on the income statement? Please select one, yes or no. Remember, you must fill out the polling questions in order to receive CPE credit. You will have 30 seconds to answer. Thank you for participating in our poll. Now I'll hand it back over to Matt.
Thank you. Our next set of questions is also for Mike, and we hear these questions quite a bit, and they are, isn't healthcare unique, and why do we need to change? Mike?
Yeah, so, as we discussed earlier, FASB did not set out to specifically target the healthcare industry or to target hospitals and specifically change revenue recognition for hospitals because they thought there was a problem with the existing financial reporting. Again, they were on a mission to essentially establish a consistent set of revenue recognition standard criteria that could be applied across all industries. But I do think it's fair to say that it did have some unique impact on the healthcare industry with regard to especially how hospitals report their bad debt. So we mentioned earlier that there was this committee that was formed by the AICPA to specifically evaluate the impact of this statement on the healthcare industry. And so I think it became very apparent to that committee early on that the biggest impact this new standard would have on hospital reporting and healthcare providers reporting would be on bad debt expense, essentially associated with self-pay patients. So if you do read through that industry guide, you'll see that's where a lot of the focus on their discussion is from their meetings and where they spend a lot of time talking. So these concepts that we've already thrown out a couple of times of explicit price concessions and implicit price concessions, these were not concepts that were created specifically for the healthcare industry. These are concepts that were created for all industries to contemplate that are applying revenue recognition criteria. But I do think that it became pretty evident to this AICPA committee formed to look at healthcare fairly quickly that this concept of an explicit price concession very closely aligned with contractual adjustments and what had always been treated as this agreed upon deduction, if you will, from revenue between a healthcare provider, a hospital, and a third-party payer. So those two closely aligned. I think it also became quickly evident to this committee that the concept of an implicit price concession very closely aligned with what has historically been considered bad debt for a hospital or a healthcare provider. So while, again, healthcare is certainly unique, I think really you just have some unique impact of applying this standard to a healthcare entity versus how a manufacturer or someone else might apply the standard to their business. So hopefully that helps Matt answer that question.
Yes, thank you so much, Mike. Our next question is it possible that a hospital could still report some bad debt expense that does not meet the definition of an implicit price concession?
Yeah, so the short answer is yes, but I think it'd be helpful to elaborate on that a little bit and maybe look at an example of where that could be the case. So what I'd like to suggest is if we could maybe, I'm going to, if I can, advance us back in our presentation to a fact pattern that we had earlier when we were looking at this example. And so just to remind you of this fact pattern, so this is the one where we had gross charges of $15,000, got the contractual adjustments of $5,000 for adjusted net revenue of $10,000, and then we had an expected third-party payment of $8,000. The patient portion was $2,000 they were responsible for. We assumed a $1,500 implicit price concession. Again, this was probably a hospital looking at their history of collecting on self-pay patients, and let's just assume for our example, I'm not sure I clarified earlier, but let's say this is kind of true self-pay, maybe not self-pay after insurance or something like that. But, so we've got $1,500 of an implicit price concession and an expected payment from the patient of $500. Our history tells us we will likely collect that $500. Now, because we have that expectation and we're going to collect that $500, if we don't, in fact, collect that $500 ultimately kind of in a vacuum, then that could meet the criteria of actually reporting bad debt expense under this new revenue recognition standard. But I think it's important to keep in mind that the new standard also provides for making this type of evaluation not on a patient-by-patient basis, but making this determination more on a collective basis, or the term that gets used in the standard on a portfolio basis. And so, you're typically, from a practical standpoint, making this type of determination maybe in payer buckets, if you will, and certainly looking at self-pay. Maybe there's some bifurcation, as I mentioned earlier, between true self-pay and self-pay after insurance. But if you have this expectation based on your historical collections that you will collect a certain amount and then you don't, you still may have some basis for reporting bad debt expense in your financial statements. It's just likely that amount's going to be nowhere near what you used to report as bad debt expense.
Thank you, Mike. Our next question is, can you explain the difference between charity care versus implicit price concessions versus bad debt?
Yeah, so this is an interesting question to me because I think there are very important distinctions here, and I think it's probably much easier to differentiate between charity care and the other two, and it probably gets a little more complicated to understand the differentiation between an implicit price concession and bad debt. So let's start then with charity care, since that's maybe the easier part to differentiate. But simply put, charity care comes from providing patient services to someone who has an inability to pay for the service. And so I think that inability is a word I would underline there. So, hopefully, even before you provide the service to the patient, that individual is going to have an inability to pay for the services that they provide. And perhaps you've already determined that they meet the poverty guidelines within your charity care policy, that you've already made the determination you'll be providing the same level of service to that patient, even though you know that they don't have the ability to pay, they don't have the financial means to pay, and they meet maybe this poverty guideline criteria within a charity care policy. And so this willingness of a not-for-profit hospital to provide that same level of service to someone who has this inability to pay, they don't have the financial means to pay, is at the very heart and core of the not-for-profit hospital organization receiving and maintaining that not-for-profit status, and therefore, of course, not paying federal income taxes. So that's, of course, what charity care is. And I know that's not new information to anybody, but just, to get that criteria out on the table to contrast to the other two. So next, let's talk about an implicit price concession. Again, this is a newer term. This is not a term that most of us are that familiar with. It's a term that came out of this new revenue recognition guidance. And so it's nothing, again, that's unique just to the healthcare industry, but it represents a discount or a concession that the provider has a history of making while continuing to provide a service. Therefore, there may be an expectation on the part of the patient or whoever is receiving that service or product in other industries that the discount or concession will be offered to them because they see it's been offered to others in the past. So again, this type of a concession is typically evaluated on a collective basis or what gets called a portfolio basis. So, for example, a hospital may look at their history over the past several years of providing services to patients that are maybe meet self-pay criteria, and they may determine that this patient doesn't meet the poverty guidelines within the charity care policy, so they actually have an ability to pay. The question is going to be whether the patient has a willingness to pay, even though they have the ability to pay. So let's just say, for example, that the hospital does perform that analysis and they determine that for true self-pay patients, they're on average collecting 20 cents on the dollar. And that means, of course, they're not collecting 80 cents on the dollar when they're providing that service. So in the past, of course, under the old guidance, that 80 cents would have been reported as bad debt expense, as a revenue deduction. Now, that 80 cents is going to be treated as an implicit price concession. So that's a pretty big difference when we look at contrasting those three. If we take a look now at bad debt, I think what's interesting is charity care, of course, nothing's really changed as a result of the revenue recognition standard. Implicit price concession is a new term and something that hasn't been around for a while. Bad debt is a term that's been around for a long time, but our definition of bad debt has now changed. So much of what used to be bad debt is now meeting the definition of an implicit price concession. But as we said in a question or two ago, there can still be true bad debt even under the new standard. So we just have to kind of alter our definition and thinking of what bad debt is now. So, aside from the fact that GAAP now has us reporting bad debt in a different way, I think it's also important to note that, and we'll get into this in more detail, I think, later in the presentation with some specific questions, but that definition has not necessarily changed for IRS tax reporting purposes and has not necessarily changed for cost reporting purposes. And I know Holly's going to go into the cost reporting piece of this in more detail. So under the old rules, the portion of gross charges that was not one of these following three areas, a contractual adjustment, a collected amount from a third-party payer, or a collected amount from a patient, for the most part, if it was gross charges and didn't fall into one of those three categories, then most likely it was considered bad debt. So under the new standard, most, if not all, of that amount that was previously considered bad debt is now going to be an implicit price concession. As we saw a couple of questions ago, we could still have some bad debt expense under the new standard if our history and analysis shows we truly expect a collect amount because someone has the ability to pay. We think they've demonstrated collectively a willingness to pay a certain amount, and we don't collect that. Ultimately, we may still have some basis for recording bad debt expense. So hopefully that does an adequate job of comparing and contrasting those three, Matt.
Yeah, that's great. Thank you, Mike. Our next question says, with the new revenue recognition standard, hospitals no longer report as much bad debt on the GAAP, or generally accepted accounting principles, basis financial statements. Does this make it more difficult for a hospital to demonstrate the full benefit they impart on their respective communities?
Yeah, well, I think it could have an impact, and also think this is a question that probably moves a little more into the territory of opinion rather than just necessarily interpretation of facts. So I will say perhaps the answer to this is just my personal opinion, but I do think it could have some impact. For a user of a hospital's financial statements that is not very familiar with the new revenue recognition standard, so let's assume maybe we've got a less educated user of the financial statement or a unsophisticated user of the financial statements, they are no longer going to see what was probably a pretty large bad debt expense line item on the income statement or statement of operations. So I personally thought it was somewhat difficult, even under the old rules, to see the full benefit, if we're really going to talk about the full benefit that a not-for-profit hospital imparts on their community, because charity care was not a line item on the income statement, only bad debt expense. So now, under the new standard, we, of course, still don't have charity care as a line item on the income statement, and we no longer have bad debt expense as a line item on the financial statement. So again, as we said earlier, while there's no bottom line impact change from this new revenue recognition standard, and we just have a different starting point, really, unless someone is either educated enough or determined enough to figure this out on their own, they're going to have to dig through the footnotes, essentially, of the financial statements to be able to see how much, essentially, is this hospital or this healthcare provider giving away, essentially, each year or contributing to our community as a benefit. So that full and total picture is definitely more challenging to find for most users, probably, of the financial statements.
Thank you, Mike. With that, I think it's time for our second polling question.
Thank you. The second polling question is, will changes in reporting of bad debt make it more difficult for hospitals to demonstrate the community benefit they provide? Please select one, yes or no. Remember, you must fill out the polling questions in order to receive CPE credit. You will have 30 seconds to answer. Thank you for participating in our poll. Now I'll hand it back over to Matt.
Thank you. Our next question is for Mike, and it says, do you agree with the point of view that some in the industry have that would say an implicit price concession is an irrelevant amount because it is based on chargemaster rates, which are artificial?
Yeah, well, I can understand that point of view. I will say as well that this is probably another question that deals a lot more with opinion than interpretation of facts. So again, this will just be my opinion on this particular question. But I do think I can understand that point of view. But I also think that if you're going to say that an implicit price concession is irrelevant for that reason, then you could easily make the same argument that charity care, the cost of providing charity care, is an irrelevant number. So I also think that line of thinking could actually be making a better argument in favor of the new standard, perhaps rather than even against the new standard. And I'll, elaborate on why I think that's the case. But I really believe the spirit behind the new revenue recognition standard is to lead a company in virtually any industry to reporting revenue at net amounts that are close to what they actually expect to collect for the services that they're rendering, or in some cases, the products they're selling in other industries. So, in other words, the spirit was to avoid a gross up of revenue in the financial statements for amounts that were never intended to be collected. So, for example, artificially increasing the chargemaster by 5% annually, of course, doesn't necessarily equate to increasing cash collection, certainly maybe not by 5%, maybe wouldn't impact cash collections at all potentially, but it could have an impact of increasing implicit price concessions by 5% or 4-point-something% perhaps, which again would support this statement in the question, which means, okay, well, that's just kind of an artificial number. It's been artificially inflated. Likewise, I would say, the disclosure that would say that it costs 5% more now to provide for the cost of providing charity care could also be described as somewhat artificially inflating that number. So there is definitely some basis for the point being made in this question that sometimes the chargemaster increases can be somewhat artificial. I think we've got more than one place where that could lead to some artificial increases. But again, those are really amounts now that FASB has essentially taken out of the statement of operations, forcing us to get down to a net number that's more reflective of what we ultimately expect to collect.
Great. Thank you, Mike. Our next question is one that we get asked very frequently. And it's, do you think it is appropriate for hospitals to continue to record bad debt expense on their internal financial statements for tracking and internal decision-making purposes?
Yeah, so one more question that probably deals with opinion. So again, my opinion, but I would say absolutely yes. I think probably the best analogy is to think about the fact that we've had gross charges and contractual adjustments for years that have not been reflected as separate line items in the statement of operations or income statements, but most hospitals that I work with certainly can tell you what their total gross charges are, and they can tell you what their contractual adjustments are. They're tracking those. I think we'll now be treating these implicit price concessions the same way in the industry. I think we'll still want to track those implicit price concessions, formerly what was bad debt expense, just like we've been tracking those contractual adjustments as just one more revenue deduction from those gross charges to get down to net revenue. So I think if we think about an example where a hospital has historically collected, let's say, 20 cents on the dollar for self-pay accounts, and let's say this has been fairly consistent over the last 5 years, then a hospital is going to want to continue to monitor its future collections against that historical benchmark and analyze any variations in collection. So that example probably alone would be enough reason for me anyway to want to continue to track and to report internally the implicit price concessions. But of course, there are other reasons. For example, federal income tax reporting, cost reporting issues where we haven't necessarily seen changes yet that have fully aligned with some of the changes in GAAP. Certainly, there are still reasons to track for reporting in Form 990 and also on cost reports, which I know Holly will get into in more detail. So, a couple of other good reasons, I think, several good reasons why you would want to continue to track internally these implicit price concessions.
Great. And Mike, we have one last question for you here. Have you heard of any plans to update Schedule H of Form 990, which currently asks hospitals to report bad debt expense?
Yeah, so for full disclosure, I certainly would not hold myself out as being an income tax expert or specifically a Form 990 expert. We have several people at our firm that are, and so just knowing that this was one of the frequently asked questions for us today, I did have a chance to speak with two of our leaders in our healthcare tax area and posed this question to them, and they both indicated that they are not aware of any changes that the IRS has announced for changes for Schedule H. So, essentially what you have then is you have Schedule H asking for bad debt expense to be reported, but when they ask for bad debt expense, they are really asking for the old definition of bad debt expense, which would include those implicit price concessions now under GAAP, as well as we've talked about, what could be new bad debt, if you will, under the new standards of where we truly have something beyond just our implicit price concessions that also meets the criteria of bad debt. So nothing that anybody in our healthcare tax area has heard of at this point that's been announced by the IRS, but of course we'll be keeping our finger on the pulse to see if there are any future changes.
Thank you, Mike. The next several questions we have are dealing more from a reimbursement perspective. And with that said, Holly, this question is for you. And it says, are there any implications from the change in reporting of bad debts in the financial statements on the cost report? Holly?
Thank you, Matt, and hello, everyone. Before providing an answer to this question, I would like to first provide a little background and briefly explain the reasoning behind including bad debt on a Medicare cost report and touch on some recent CMS clarifications related to Medicare bad debt. Providers report bad debt on their Medicare cost report for two main reasons. One is to obtain reimbursement for their allowable Medicare bad debt. And the other purpose for Medicare disproportionate share hospitals or DSH-eligible hospitals is to receive an additional inpatient payment for treating a disproportionate share of low-income patients. And it's used to determine the allocation of the uncompensated care pool program funds. Going back to the Medicare bad debt reimbursement, providers compile logs or listings which include all unpaid and uncollectible, deductible, and coinsurance amounts for Medicare beneficiaries, and then they receive 65% reimbursement from Medicare after satisfying some rigorous government criteria to receive that reimbursement. And there's three types of Medicare bad debt: traditional, crossover, and indigent. For the traditional or regular bad debt, this is where the Medicare beneficiary is not Medicaid eligible and they do not qualify for charity. So the collection efforts are required for this type, and these cannot be claimed on a Medicare cost report until they are returned from final collection. The dual eligible or crossover bad debt, this is where the beneficiary is eligible for both Medicare and Medicaid, and providers are required to bill the state Medicaid program for these, and they can claim any unpaid deductible or coinsurance for crossovers. And the third type is indigent bad debt. For this type, the beneficiary is not eligible for Medicaid, and indigency is determined by taking into account the patient's total resources in accordance with the hospital's unique charity policies. Now, CMS released a clarification in April of last year related to the Medicare-Medicaid crossover bad debt that caused a lot of confusion in the provider community. The CMS communication on their MLN Connect site stated that providers will be denied reimbursement for their Medicare-Medicaid crossover bad debts unless their underlying balances were logged to a bad debt expense account in their financial accounting records. And that became effective 10/1 of 2019. And now this announcement appears to create a conflict between the GAAP rules that Mike has just described and the CMS policy for the reimbursement of crossover bad debt. Traditionally, providers have logged crossover balances to contractual allowance accounts while claiming reimbursement from the Medicare program for these, and this was previously deemed acceptable. And there's an on-demand webinar on our website that explains what led up to all of this and goes into a lot more detail. But ultimately, CMS clarified in April of last year that providers will now be denied reimbursement for crossover claims that are not logged to a bad debt expense account for uncollectible accounts. And while the new revenue recognition standard may dictate how charges and related adjustments are presented in the financial statements, it does not mandate how write-offs are handled in the patient accounting system or the general ledger. So for this reason, it should have no impact on how you handle and report your Medicare bad debt. Our recommendation for meeting both Medicare and GAAP requirements has been to make sure that the Medicare bad debt write-offs are mapped to a GL account that has bad debt expense in its name, and maybe one that's used specifically for Medicare bad debt may be best. And many providers have worked closely with their system vendors to accomplish this. And at this point, there's still some uncertainty about how the MAC will be auditing this and what requirements and support are going to be necessary. So for now, you'll want to just consider evaluating your process for recording these write-offs in the general ledger and internal reporting records. Identify bad debt expense account adjustments uniquely by name. Closely review all cost report communications from your assigned MAC or Medicare administrative contractor, and request a reopening for any denials that you may have received related to this issue prior to the 10/1 effective date. Also, be prepared to evidence the proper classification of dual eligible or crossover bad debt for CMS reimbursement purposes, and be aware that a reconciliation between the Medicare bad debt and the external financial statements, your implicit price concessions, may be requested by the MAC. And for now, it's really only the crossover bad debt that has been affected by this change. Now, circling back to the other type of bad debt reported for uncompensated and indigent care on cost report worksheet S-10. The S-10 data is used in the computation of factor 3 included in the calculation of the uncompensated care payment for 1880-60 hospitals under the Social Security Act, the short-term acute care hospitals that are eligible to receive these payments. Starting in 2015, the uncompensated care cost was used to determine a hospital's portion of the DISH pool, which totaled around $8.2 billion for the program in 2019. 75% of that pool funding is based on this worksheet S-10 data. And Congress had created the disproportionate share hospital or DISH program in the early 1980s to help hospitals offset the costs of providing care to low-income patients. Under the Affordable Care Act, Section 3133 requires that for FY14 and after, subsection D hospitals that would otherwise have received a DISH payment will instead now receive two separate payments, a DISH payment and a payment for the hospital's proportion of uncompensated care. In the 2018 Medicare IPPS final rule, CMS indicated that it would begin to incorporate data from this worksheet S-10 and the computation of the factor 3 to calculate hospitals' share of uncompensated care payments for FY18. And the factor 3 is the scaled average ratio of hospital data to national data. I don't want to get too much into the details on how this is calculated or all that is included in disproportionate share. I think we could do a whole webinar just on this topic, but I would like to touch on some of the differences between Medicare and GAAP reporting of charity care and bad debt. CMS's definition of uncompensated care is that it consists of charity care, non-Medicare bad debt, and non-reimbursable Medicare bad debt, so the remaining 35%. Uncompensated care does not include courtesy allowances, discounts given to patients that do not meet the hospital's charity care policy, or discounts given to uninsured patients that do not meet the hospital's financial assistance policy, or for bad debt that's already being reimbursed by the Medicare program. CMS defines charity care and uninsured discounts as resulting from a hospital's policy to provide all or a portion of services free of charge to patients who meet the hospital's charity care policy or financial assistance policy. For S-10, it can include full or partial discounts. If a patient is not eligible for discounts under the charity care policy or financial assistance policy, then any discounts or reductions given to the standard managed care rate must not be accounted for as charity care or as an uninsured discount. Discounts given to patients for prompt payment must not be included as charity care. For S-10, charity care is not reimbursable, and unpaid amounts associated with charity care are not considered as an allowable Medicare bad debt. Charity care is reported at charges and converted to cost. So for IRS purposes, charity care does not include bad debt or uncollectible charges written off due to default, the cost of providing that care, and any contractual adjustments for third-party payers. And for the GAAP reporting, as Mike was talking about, charity care is excluded from the determination of net patient service revenue. Footnote disclosures of costs of charity care can be based on various methods, and bad debt is shown as a reduction in net patient service revenue. For Medicare purposes, charity care is reduced by actual patient obligations and bad debt write-offs, and adjusted to cost using the Medicare cost-to-charge ratio. So there are differences in the reporting of each of these, GAAP versus IRS versus CMS. And Matt, I'm going to go ahead and turn it back over to you now for our next question.
Yeah, that's great. Thank you, Holly. The next question we have for you is, given that bad debt has been replaced with implicit price concessions for financial reporting purposes, how can hospitals track and report bad debts for cost reporting purposes?
CMS has historically defined bad debt expense as amounts to be uncollectible from accounts and notes receivable which are created or acquired in providing services and represent reductions in revenue. And the Code of Federal Regulations requires providers to maintain sufficient financial records, and these financial records should be widely accepted in the hospital and related fields. And the tracking and reporting of Medicare bad debt can be accomplished by evaluating how these amounts are recorded in the general ledger and ensure the crossover accounts are being written off to a bad debt expense account for uncollectible accounts as required by CMS, as opposed to a contractual write-off in the GL. And again, GAAP presentation of bad debt and uncollectible accounts for external financial reporting purposes does not dictate how providers code and classify Medicare bad debt in the GL, internal use financial statements, or non-GAAP filings with CMS. There is, again, a possibility that the MAC may request a crosswalk or reconciliation between the Medicare bad debt and the external financial statement. So you should be prepared to provide this if it's requested. And the same is true for the S-10 charity care, uninsured discounts, and bad debt. Hospital policies and transaction code reports can be used to determine which transaction codes represent the appropriate amounts to report as uncompensated care, considering the value that each transaction represents, charge versus expected payment, and including any account reversals or takebacks. So S-10 bad debt for Medicare purposes is based on actual write-off amounts. It's not an estimate or a provision. It excludes the professional component, and the net amount is reduced to cost. It would be a good idea to develop a cross-departmental work group, maybe including reimbursement and revenue cycle, review your current policies, implement governance for data integrity, relay timelines and deadlines. Medicare cost report is typically due 5 months after the year end. So the revenue recognition standard has no real impact on how providers currently track and report cost report bad debts, but the CMS requirements are also changing, so it's best to keep up with these changes and be aware of the different methodologies used for GAAP and IRS, and essentially they could create some reconciliation issues. Also consider that it's still a little too soon to know how the Medicare administrative contractors will be auditing bad debt, both on the Medicare bad debt side and the S-10 data. Since there's often inconsistencies between the MACs, and many of the changes being implemented are fairly recent and just starting the audit process. And with that, I'll send it back over to you, Matt.
Thank you, Holly. I think now it's time for our third and final polling question.
Thank you. Our third polling question is, would you like to see bad debt expense go back on the income statement as a separate line item? Please select one. Yes or no. Remember, you must fill out the polling questions in order to receive CPE credit. You will have 30 seconds to answer. Thank you for participating in our poll. Now I'll hand it back to Matt.
Thank you. And Holly, with our couple of minutes remaining here, we have one final question for you, and that's, do you anticipate any future changes in the reporting of bad debt and cost reports given the changes in the financial reporting of bad debt?
I don't foresee anything new in the near future relative to the changes in the financial reporting of bad debt. There is still some uncertainty out there regarding if and how CMS guidance could have any implications to the way that traditional and charity bad debt will be reported or classified internally, and we'll provide additional clarifications on our website as this continues to develop, and also relay any developments or new information related to the audits happening now on the worksheet S-10 uncompensated care piece. There's also been several budget proposals, probably worth mentioning, that including the most recent budget proposal that has recommended a change in outlay. There have been proposals in the past to reduce the percentage of allowable Medicare bad debt from the current 65% to 45%. More recently, to reduce the percentage of allowable bad debt to 25% reimbursement. And there have also been proposals to completely eliminate the coverage of allowable Medicare bad debt. These have all been excluded from final rule so far. So the 65% reimbursement rate remains in effect right now for Medicare bad debt. So just something to be aware of. And now I'll turn it back over to Matt for questions.
Yeah. Well, thank you, Holly. Well, I appreciate it. And let me just say thank you to you and Mike for your expertise and time on the webinar this morning. And thank you to everybody listening out there for your attentiveness, and appreciate you being with us. At this point, we'll turn it over to Laura, who's going to have some final kind of closing instructions for us. And again, we certainly appreciate everybody's time this morning.
Thank you. And thanks to our presenters, Matt Stuart, Mike Shamblin, and Holly Bizic. If you have questions, their presentation and contact information will be emailed to you along with a recording of today's webinar. Also, if PYA can provide assistance with audit, tax, compliance, valuation, or physician services, call or email us. You may also visit our website at pyapc.com for more details about our specific areas of expertise, or to subscribe to receive PYA insights. Please remember to stay on the line once the webinar disconnects to complete a short survey for CPE credit. On behalf of PYA and FHA, thank you for joining us, and have a great rest of your day.